Best ever listeners, welcome to the best real estate investing advice ever show. I'm Slocum Reed. This is the world's longest running daily real estate investing podcast. And today we have Jonathan Nichols with us. How you doing, Jonathan?
Great, Slocum. Thanks for having me on the podcast today. Excited to be here.
Jonathan is a full-time syndicator at Apogee Capital, which helps people passively invest in value-add multifamily real estate. He is the GP on 200 multifamily units, 18 short-term rentals, and LP on 250 units. He worked for 10 years as an aerospace engineer and went full-time in real estate in October of 2021, just a few months ago. He's based in Arlington, Texas. Jonathan, reading your bio, I have to ask, your 18 short-term rentals, is that a deal that you syndicated?
Well, it's actually a mix. And so we have a few different genres of short-term rentals. So we have some residential properties that my wife and I own, which is how we got started in real estate several years back. We have a few arbitrage units, which is where we rent and then re-rent the units on Airbnb. And then finally, this past year, we did an 8-unit JV property. So not a syndication, but a JV property. That's short-term rentals. So that's kind of our hybrid between multifamily and short-term.
Gotcha. What does your joint venture look like on that 8-unit with STRs?
Yeah, absolutely. So as my wife and I, as we start scaling up in short-term rentals, we really spent a lot of time developing our team and our business structure and stuff, and got it to where it was fairly efficient. And so I had this idea, hey, I'm jumping in the multifamily world, doing syndications and JVs and stuff like that now with multifamily. What if I could buy a small multifamily property and convert it to short-term rental, and thereby get higher cash flow, higher returns for the folks on the deal? And so I had a few partners who were on other multifamily deals with me that were interested in that business model. And so basically, I took over the role of managing, or rather my company took over the role of managing the short-term rental side of the project. And of course, I put together the deal itself, as far as not the syndication, but just the transaction and the rehab and all that necessary to start doing short-term rental.
Nice. Is that the other deals that you have syndicated, those 200 units, where are they?
Yeah, so we have one deal, which was our first deal that we were co-GPs on, up in Tulsa, Oklahoma. And so we did that one early part of last year, and it's taken off and doing very well. And then we have another deal that we just closed on in College Station, Texas, towards the end of last year. And it's actually an A-class student housing type project. And so we were the lead syndicators on that deal.
Tell me more about that Class A student housing syndication. You said you bought it late last year. What did that property look like when you were proposing it to potential investors?
Yeah, it was really interesting, because the first question that I got asked on it is, okay, it's A-class, so there's no value add. It's not a value add deal. Well, in fact, it is a value add, because value comes in a lot of different ways, right? And so the story behind this property is that it had been owned by a mom and pop owner for quite a good bit of time, and their primary interest in the property was just having it 100% occupied and easy to manage. And so while they took good care of the property, they didn't necessarily push it to its potential. And so we took over the property. It's only 8 or 9 years old. Doesn't need any type of major rehab on the units as of now. And basically, we're starting to implement professional management, professional marketing that will drive rents up to market in a tertiary market in Texas that's actually rather strong. And so the value on this is just the management play, where we're able to hit market rents that the previous owner was not seeing on that particular property. And so so far it's off to a good start. We're really excited about it, but it's definitely a little bit different than a lot of the typical C-class value add syndications that probably investors are used to coming across.
Yeah, C class has, and to some degree B class, have kind of become synonymous with that term, value add. Let's talk about value add for a moment, because when you boil down the definition of value add, you're talking about increasing the value of the property, which at the end of the day comes down to one of two variables, or both. Either value add is either increasing the NOI or decreasing the cap rate. And there's no reason why that can't be done in A class the same way it can be in B or C class. Yes, a higher percentage of the operators in an A class situation are going to already be performing optimally to the market. But you're talking about an ownership situation that is very familiar to C-class operators. The mom and pop who wanted to be stable and safe and low hassle instead of pushing income. They were primarily concerned with the lifestyle for themselves that resulted from the property more so than the NOI, which left an opportunity for you to increase the value and syndicate an A-class student housing deal. Am I missing anything here?
No, I don't think you are. And honestly, I think your best point is just that flaw that a lot of people have tied value add specifically to B and C class. And so, and most of what I look at, to be clear, is B and C class properties, like everyone. But I get a lot of deals across my table that are C class, and it'll be marketed as C class value add deal. Well, really what it is another syndicator bought it 5 years ago, and they've taken most of the value out of it, and it's a turnkey property. And there's nothing wrong with that at all. There is a right buyer for that property, but it's no longer a value add deal because most of that's been squeezed out. And so, by the same token, you go look at an A class that has value add on it. And, it's going to look a little bit different as far as the return structure and such. But the reason that A class typically sells for higher is because it's lower risk. And so, when we were talking to investors, one thing we explained to them is, hey, you probably can go find 10 C class deals that would have a lot higher returns than this deal. But this is going to be a lot lower risk deal that's more likely to appreciate. And on top of that, we're in a market that has strong economics behind it. And so, we really believe in this project. And of course, that's not even considering the tax benefits that went along with it. So,
are the tax benefits anything beyond the ordinary?
I would say not, because, the property by itself, yes. But if you have a true C class with value add on it, you're going to get a lot of tax benefits from that value add if it's executed properly and all that. And so you're not going to see as much of that. So it's probably, pretty much in line with what you see on most syndications. But, we definitely had investors who, because we were approaching the end of 2021, were, concerned about their tax bill in the upcoming year, who said, we need to put money in a good project. And so, we had a low risk project with great returns and, the normal cost like tax benefits. And so they were sold.
College Station, Texas makes me think of the Aggies, but are there any other major employers in College Station outside of Texas A&M?
Yeah, that's a great question. So first of all, my wife and we both went to Texas A&M. That's where we met. And so we're very familiar with the market, because we've lived there for several years. Historically, Bryan College Station has been, I would say, outside of the school, somewhat of a flat market. But in recent years, there are a number of large, well-known companies that are putting tremendous amounts of money, on the order of hundreds of millions of dollars, in a market with 250,000 people. And so the job growth that you see, the employment growth, the population growth outside of the growth of the school itself, it hits all the metrics that most syndicators look for in a solid market. And so that's something that's come to play, I would say, in the last 2 to 3 years, particularly. And so I think it's a market that's well positioned for success in the near future.
I am in Cincinnati, Ohio. We have a couple of great universities here and very solid student housing markets within Cincinnati, but I'm not in them yet. When you were evaluating this deal in College Station, I say that because I'm really asking out of curiosity here. College Station, 250,000 people, relatively flat outside of the university. When you are underwriting the area, knowing that this is going to be dedicated student housing, are you weighing the growth of the university against the other economic factors affecting the market?
Well, that's a good question. So first of all, while it had historically been a bit of a flat market, now it's actually growing rather rapidly. So outside of the university, the population growth because of these new employers that have come in the market. And so when it comes to the student housing side of it, you do want to look at the university as well. And A&M's largest public university, largest university in Texas, the population growth, the student population growth is extremely high and has been for a number of years. And so I think it bodes well with property performance. This particular property, once again, remembering that my wife and I are very familiar with the town, it's in really an impeccable location. It's very desirable for students who want to live because it's within biking distance, walking distance of the university. And for anyone who's familiar with very large universities, not every school do you have the ability to live and walk to your university. And some of the larger schools, you may be riding a bus for a while or have to drive, et cetera. And so that benefit of the location alone was something that we took into consideration. But really, at the end of the day, there were two things that we were evaluating in order for us to feel comfortable signing the PSA on this property. One, what was the lending environment? Who was willing to lend on the project? And so we found a couple different good options, and one that we were particularly happy with, and two, who was going to manage it. So, to back up a step, I have folks come to me on the short-term rental side of things all the time and ask me questions about buying a short-term rental. And the first question I'll ask them is the same, which is who's going to manage it?
Yeah, totally.
You need someone that is a professional in that specific type of environment. And so, we found a local management company who is headquartered in College Station, been there for 20 years, does not only student housing, but also manages a few hotels as well. And so when it comes to the intensity that comes with the turnovers and the schedule that you see with that, they were very well prepared to take on this project. And so those are kind of the two things that, led us to believe we were going to be successful in this project.
Jonathan, I want to ask you a little more about the debt that you got for this deal, but first, a frame of reference for the debt conversation. How big is this property? How many units? How much did you pay? How much were you looking to, did you have a value add budget?
Yeah, so the property itself is 75 units. They're all townhome style, so the units are very large. And so
is it a rent by the bedroom situation?
It is not. And so that's another thing that made us comfortable with it. It's not rent by the bedroom. And it's also 12-month leases. And so while the percentage of students living on the property officially made it a student housing project from a lending perspective, we do have a lot of full-time professionals that live on the property, professors, or even like graduate students, pursuing PhDs that are going to be there for a long time. And it's really a lot different than a straight student housing project, to be honest with you. So there's a component of both in there, but it's 75 units. And trying to, what else did you ask me about it particularly?
How much did you pay for it, and what was your projected reno budget?
Yeah, it was a $8.5 million property, which was like a 5.5 cap for this market, which is really incredible for A class, honestly. And the reno budget there's really nothing on the interiors that need upgraded. It's a new enough property that just the finishings, the flooring, et cetera, is all in great condition. It's more of just kind of minor exterior things. And so, we had a pretty light budget just for a little bit of deferred maintenance on the outside. But I wouldn't even call it a full CapEx budget, to be honest. It's probably what most people would, just put into reserves. But it's stuff that we identified going into the project was going to need to be repaired.
What kind of rent growth potential did it have when you bought it? This doesn't sound like something that's going to get a big bump in rents, but like you said, previous mom and pop owners who cared more about making things easy than profitable.
Yeah.
What were you looking at?
Yeah. So, what we needed was to be able to get, 5 to 7% rent growth in the first year in order to hit our pro forma. And what we're seeing is that we're somewhere around 10 to 12% below market rents as of today. What's interesting is that Texas A&M is home of a real estate research center in Texas. And so they do research on real estate all across the state, and obviously are well versed in their local market as well. And so they released an article here within the last month or so, basically stating that 2021 properties had seen 10 to 15% rent growth nominally across the board. So we're talking properties that were already at market rent, seeing those kinds of rents.
College Station.
That's correct. And they're expecting that again in 2022. And so, for us going into this project, that was something that, really made us comfortable with it, because, the rents that we were needing to hit our pro forma were, well below what's projected just from nominal rent growth outside of properties that are, maybe below market as is.
Yeah. The rising tide lifts all ships. For sure, it's a good time to be taking advantage of what's happening in the market when it comes to rent rates. So 75 townhome units, technically classified student housing, but you have a mix there of tenants, professional as well as student. 75 doors, 8.5 million, pretty stable, a little bit of rent growth potential. I mean, this sounds like a dream for most lenders. What kind of debt structure were you looking at?
Yeah, one of the things important to our team was to find non-recourse lending, and so that was probably the most challenging. And so if you have to go back to the history of the market there in College Station. So agency was not particularly interested in this project because, one, they're not big fans of anything that they would identify as student housing. But more so, if you look back at the history of the market several years back, there was a lot of development of new A-class student housing between, let's say, 2012 to around 2016 in this market. And for a brief time period, the market was even a bit oversupplied on student housing. And so I think that some of the lenders were concerned about that and not looking at some of the metrics, because what really matters in a market, if I tell you, hey, so look, I'm going to buy a property in Austin, you immediately think, oh, that's a great market, but why do you think that? And likely it's due to what it's done in the past, right?
It's because of how many people say Austin all the time.
Exactly.
You hear it everywhere.
But what we really care about is, what is the market going to do in the future? And so,
of course,
while we don't have a crystal ball, there is a lot of research and data that can give us an idea of what it's going to do in the future. And so some of that I already mentioned, right? Companies coming in, investing enormous amounts of money, job growth, population growth, low unemployment, particular to this property, and a university that also has population growth, a subset of students who have no issues paying rent. And so, presenting all that to the lenders, once we found a group of lenders who were interested, A, in student housing, and then B, in non-recourse lending, it was actually a pretty easy sell. So it's just finding the people who are interested in that kind of project.
So what terms did you get?
Yeah, we got so we were able to get 75 LTV, which is pretty right down the fairway, I would say, in Texas. Don't need any CapEx money because the repairs are minimal, so that's not really much of a concern. 30-year AM, low DSCR, so it all worked out pretty good, honestly, in the end. A lot of it was just really being clear on our business plan, on providing evidence of the property's current performance. Like I said, because it was a mom and pop owner, they had done all the right things as far as screening tenants and running the business well, but it just wasn't the most organized. And so we, as the sponsors on the team, had to do a lot of that organization and then present that information to the lender. And so at the end of the day, you think that the lender's trying to sell you a product, but it's really you trying to sell them a property. And so you have to approach it in that manner if you want to be successful.
Yeah. And I know that 30-year amortization is going to help your cash flow a bunch. Did you underwrite this to the 5-year hold? Is that the plan?
That is the plan. And we're seeing in the Texas markets, a lot of sponsors are choosing not to hold properties for 5 years. Just when you look at cap rate compression, combined with rent growth, a lot of them are not having to hold properties that long to hit the equity multiples that they're projecting to investors. And so, my hope would be that we would see something similar on this project, because it's more of a management play than a rehab play. It won't take as long to implement our value add strategy on this project. But at the end of the day, we want to be conservative. And so it's a 5-year business plan. It's a 5-year note. And so that's what we've underwritten it as.
Gotcha. Awesome. Well, Jonathan, are you ready for our best ever lightning round?
Better now than ever. Yep. Ready to go.
Awesome. What is the best ever book you've recently read?
Wow, that's a great question. I'm going to name a non-real estate related book and say The One Thing. And the reason I like that book is that when I was trying to lock down our first multifamily project, it really helped me with just not only the mindset, but the organization behind trying to accomplish, what to me seemed like a very large goal. And so for any listeners that have a big goal going into 2022 and haven't read that book, I would definitely recommend it.
The One Thing is phenomenal for sure. What is your best ever way to give back?
That's an incredible question. So a couple of years back, actually several years back, my wife and I were privileged to go on a trip to Tijuana, Mexico, and build a house there for a family over an extended weekend, and then made it basically a family tradition of ours to go back every year up until COVID hit. And honestly, it's been one of the most impactful things that I've had the opportunity to participate in. And so we're hoping to get back into that this year, but I really enjoy that a lot.
Nice. And what is your best ever advice?
Yeah. So, it sounds really generic, but what I would say, especially to newer real estate investors, is just to have that never quit mentality. It amazes me how many people come into this industry with maybe minimal experience or a resume that doesn't seem to suggest that they're going to be successful, but then they wind up being incredibly successful. And I think the one thing that ties the people that succeed is that they all are very committed to the outcome. It's not about saying, well, I'm going to give this amount of effort, and if it doesn't work, then whatever. They just have this attitude that they're willing to write a blank check, and whatever it takes, they're going to get it done. And so that would be my advice: is figure out what it takes and work hard until you succeed.
That's awesome. Jonathan, where can people get in touch with you?
Yeah. So as you already mentioned, the name of our company, my wife and I's syndication company, is Apogee Capital. We have a really great website, which my wife actually built, called Apogee MFC, as in multifamilycapital.com. It's got all kinds of resources, typically targeting towards, passive investors who are interested in multifamily commercial real estate. We have a free ebook. So that's definitely a great way to get in contact with us. Also, I'm rather active on LinkedIn. And so if you search for me there, I'd love to connect with you if you have any questions or just want an introduction.
That's great. Jonathan, thank you. And best ever listeners, thank you for tuning in. If you enjoyed this episode, please subscribe to the podcast, leave us a 5-star review, and share this with someone who could benefit from what Jonathan shared with us. Thank you and have a best ever day.